The Union Budget 2025 is out and global markets are shifting fast. US tariffs on China, a slowing world economy, and the government's fiscal positioning means that we need to be very strategic about where we put our money. In this video, I'll cover 3 clear investment ideas, 3 sectors to avoid, and 3 major predictions for what comes next, including why I expect inflation to rise, a new tax code to widen the tax net, and why private companies may struggle to raise debt. Also, I won't be wasting time explaining tax slabs because honestly, all my subscribers should be aspiring to be in the 40% tax bracket. If you're not, you need to be thinking bigger. But if you still want me to break it down, then drop a comment and I might just do it. If you want detailed and real-time insights into how these themes play out, join my Telegram channel where I break things down daily. The link is in the description. And as always, subscribe to the channel and leave a comment if you found this useful. Now let's get into it. I know that I'm late to the video and many people have already rated the budget 10 out of 10, but I feel that a lot of nuance is missing. I hope you understand that it takes time to read the finance bill, then the memorandum to the finance bill, and then by the time I was done, Uncle Sam came out with his tariffs. So I had to go back and rework the entire thing. So without any more delay, here we go. First, let's talk about the macro setup or the big picture. Now, this budget was about stability and not expansion. There were no new taxes on capital gains, no big stimulus packages, and no major reforms. But one key surprise was that infrastructure spending has been kept flat at 11 trillion rupees instead of increasing as many had expected. At the global level, India now faces higher US tariffs on Chinese goods, which could impact global supply chains. The rupee has been weakening and inflation risks are rising as consumption picks up. Given this backdrop, let's discuss where to invest. First, let's talk about 3 investment ideas. Where to put your money. The first investment theme is gold and US dollar exposure. Geopolitical risks remain very high, and with the US Federal Reserve expected to cut interest rates, gold remains a very strong hedge. The rupee has been losing ground, so exposure to USD based assets, whether through ETFs or global investments, makes a lot of sense. The second area to focus on is private sector banks. With strong credit growth and no major tax changes, lenders are well positioned and some of them are very attractively priced. The government's decision to keep infrastructure spending flat gives some visibility by keeping liquidity stable for private lending. The third sector to watch is large cap consumer names. Now, the government has increased the tax rebate limit under Section 87A to 12 lakh rupees per year, which means that more disposable income for the middle class. This benefits companies which have strong pricing power in the consumer and durables space. Now let's talk about 3 sectors that I would avoid or where not to invest. First, oil marketing companies or OMCs. The government has reduced its LPG subsidy allocation from 14,700 crores to 12,100 crores. That means that OMCs like HPCL, BPCL and IOCL will have to absorb more of the under recovery costs which are already very high at 30,000 crores in the first 9 months of FY25. Market reaction has been immediate. OMC stocks have fallen over 5% post-budget, and given that this increased financial burden is there, they are not going to be an attractive investment. Second, traditional infrastructure plays, excluding renewables and logistics. The biggest takeaway from this budget is that no increase in infra allocation has been done. This means that construction and infra-linked businesses that relied on new government projects, they will face stagnation. Some logistic players could still benefit from supply chain shifts, but broad-based infra stocks remain unattractive. Third, overvalued conglomerates. Some of India's largest business houses are trading at very stressed valuations despite high debt levels. Given the current fiscal outlook, companies that have expanded primarily through leverage rather than cash flows are very vulnerable. And now 3 predictions. What comes next in the future? First, inflation is going to stay elevated. With the new 12 lakh rupees tax rebate, middle class is going to increase their discretionary spending, pushing up demand for food, services, and essentials. At the same time, RBI is likely to cut rates in February, making credit cheaper and further stoking inflation. The impact will show up in higher food prices and more shrinkflation, where companies will reduce the product sizes instead of raising prices. Second, the new income tax code will expand the tax rate. The government has given away 0.3% of GDP in tax relief, and it needs to bridge that gap. A wider tax base is the most obvious solution. Expect changes that increase compliance, bring more professionals and gig workers into the tax fold, and possibly rationalize exemptions as well. This will be one of the biggest policy shifts in the coming year. Third, private sector borrowing will get crowded out. The government still has a fiscal deficit to fund and cannot cut welfare spending, so it will have to rely on borrowing, which means that higher bond yields and less availability of debt for private companies. which will impact businesses that rely on corporate bonds or bank loans for expansion. Finally, to summarize everything, the best investments right now are gold and USD exposure, private banks, and large consumer names. Sectors to avoid include OMCs, traditional infrastructure plays, and over-leveraged conglomerates. And looking ahead, expect inflation to remain elevated and a major overhaul of India's tax system and a tighter borrowing environment for private players. If you want more in-depth, real-time insights, join my Telegram channel where we discuss actionable opportunities every day. The link is in the description.